right, super. Thanks everyone for coming. It's wonderful to see a lot of familiar faces in here, including these faces, but wonderful to see a lot of familiar faces. Just as a reminder, I'm going to be the moderator today. What do? Our team manages the multi-asset class fund of funds. Right, so if you use the managed portfolios, the private investment pools, the monthly income suite, any fund of funds at Fidelity for Canadian investors is managed by us. And as Dave just mentioned, it's about $100 billion, and the managed portfolios just passed $50 billion. We got donuts for that, by the way, which is great. So there's a lot of topics for us to talk about today. We're going to be pretty fast paced here today. And the first question I'm going to start with, David Wolf. The last time we were on this stage was in January of this year. I was thinking last night how to phrase this question, and I think the best way to phrase it is WTF.
So I think that's an excellent way to phrase it, and I think that's how a lot of us feel. So let's go back to that conversation that we had on this stage, would have been late January. So at that point, and we talked about this, the US economy, the US market was frankly ascendant, right? So earnings have been booming, market was up 20+% for 2 years. Fed had executed basically a perfect soft landing. And Trump had just been elected. And for whatever one thought about him personally, the view was we were going to get basically good things for the economy. So we're going to get tax cuts, we're going to get deregulation, reinvigoration of animal spirits. So yeah, the US market was expensive, but it seemed justified.
Right.
So that was our view. That was the market's view. What we've gotten is not that, to say the least. So we haven't had tax cuts, we've had tax increases. So a tariff is a tax. And I wish they used that word because I think the view would be quite different.
I don't think they're going to use that word.
I don't think they're going to use that word. But a tariff is a tax. So what we've seen is actually the largest tax increase in the history of the United States. We haven't had deregulation unless you count firing all the regulators.
Right.
And we haven't had the reinvigoration of animal spirits. We've had, caution, uncertainty, hesitancy in CapEx in particular. So we've gotten something very different from what we thought. This became clear to us, not long after Trump was inaugurated in sort of early February. And the thesis that we coalesced around was the market was priced for maximum US exceptionalism just at the point where the new administration seemed intent on undermining the things that made the US exceptional. And that's fundamentally rule of law, property rights, stable and strong institutions, predictable governance, all of these kinds of things. So we acted,
right,
as you know. We sold a lot of US assets in the first quarter, US equities, US treasuries. We bought Europe, we bought Japan, we bought gold, we bought inflation-protected securities, we bought some liquid alternatives. So we were very much of the view that the US generally, and the US equity market in particular, was in trouble, and that we needed to get out, and we took steps to get out.
Yeah, it's really interesting. I mean, I think about last year, we spent all of last year talking about exceptionalism, right? This is exceptional just in a different way. I mean, so the natural question I think that a lot of you are thinking right now is, well, why didn't you do more? Why not more?
Yeah, so, I mean, it's a totally fair question. And, in the limit, and I've had folks come up to us to ask this, is if you thought things were going down, why didn't you just go all to cash, right? And the answer there is, and this, by the way, I'll spend a couple of minutes on this, is probably going to be more important in terms of all of our businesses than anything we talk about with respect to the macro, the outlook, what have you. So if you want to go all to cash, you actually have to get two decisions right.
Yep. The
decision when to get out and the decision to go back in. Yep. And even if you're lucky enough to do the first one, the second one is really hard too. In fact, I don't know anybody who's reliably good at getting both of those right. And I know a lot of people who are reliably bad at getting those right. And I think, a lot of folks in the audience will relate to this, that, a lot of individual investors in particular who are emotional will sell at the wrong time and buy at the wrong time. And it's this sort of behavioral drag where a client's experience actually falls short of just the fund returns because you're in and out at the wrong time. So I'll give an example of how all of this works. So let's say Trump was elected. You are of the view that, hey, everyone is wrong. Yep. This is not going to be great. This is going to be terrible. This is going to be a you-know-what show. I need to get out of the market. Yeah. So when do you do it? Do you do it when he was elected, when he was inaugurated? And let's say we split the difference. You wake up on January 1st and said, this is not going to be the great year that everybody says it is. I'm going to go all to cash. Well, actually, relative to a balanced strategy, it hasn't helped you at all. Mm-hmm. So our global balanced managed portfolio, our largest fund, is actually up on the year. Most of the funds that we run are up on the year. If you had been in cash, you would have ducked, obviously, the volatility, but you still have a problem. Is here where you get back in? Is it 10% higher? Is it 10% lower? These are questions that you don't have to answer if you stay involved and stay invested in a diversified portfolio. And I've always thought, and many of the folks in the audience have known me over a decade in running these funds, for all that we do in terms of active allocation and generating outperformance, maybe the biggest part of the value proposition is if you're diversified, it helps people stay involved, stay invested. It ultimately is going to be good for everybody.
Yeah, that's a really, really powerful anecdote, I think. I mean, again, I think of my 82-year-old father-in-law. The news goes on at 7:30 in the morning when he wakes up, and the news gets turned off at 10:30. And one of the things I've learned is the news is not your statement, right? And so, to your point, DW, right? Our funds, our balanced solutions being up year to date, right, is a really sort of powerful anecdote around that. DT, I want to turn to you. So, DW sort of unpacked where we were from the start of this year, a very different world than where we were last year, for example, and even just a few months ago. Where are we heading? Where do you think we're heading? And how are you thinking about that?
Well, you leave me with the easy question, right? It's easy to go back and reflect on the past, but I think it's helpful to just get a sense of really what we've done. I mean, DW outlined the broad contours, but really digging into the change, and I want to underscore a point, is that we generally respond to the market environment, and the market environment in recent cycles has been one of incrementalism in terms of the tilts that we've taken. So views evolve, and we tend not to really swing the funds around a lot because that's, I think, in response to how the market provides us with opportunities. But one thing we have done is to move things a fair bit. So this is, I think, entirely appropriate, and we've talked a lot about in the dark days of the tariff headlines that you don't want to overreact to the headlines, but at the same time, you don't want to underreact to these developments either. And this was a pretty substantial change, not only in the outlook, but in how we were positioned. So one of the things that we did fairly quickly was just to take down risk. And I think that's an appropriate response to a lot of things that were just effectively unknowable. And when people offer opinions, those opinions don't really carry much weight because truthfully, these are decisions that are being made by maybe 1 or 2 or 3 people in the entire planet. So trying to understand a certain amount of humility and finding opportunities where we don't have to take a lot of risk and we can find sort of more durable themes to invest around is something we were looking for. So taking down risk was the first decision. The second was to really, as DW mentioned, move away from US assets. So a lot of this was in the context of the US dollar. So the US dollar, again, really embodied that theme of exceptionalism. It was a very expensive currency, and for a while, that degree of overvaluation seemed warranted by the fundamentals, but then when you chop away at the fundamentals, that overvaluation becomes quite apparent. So looking more towards EFI currencies and other currencies around the world was part of that rotation. And then secondly was just on the equity allocation. So out of the United States, more towards Europe, more towards Japan, more towards emerging markets. We'll unpack the Canadian question too, because that one is a little bit more nuanced. But generally speaking, trying to limit the exposure to the US equity market was the second major thing that we did within the funds. And then the third was to really understand the notion of tariffs and the policy uncertainty as being effectively a stagflationary shock. And that is a shock where you want to be able to have protection against inflation, but also be wary of the growth hit that comes through all of these developments. So adding a little bit more into gold, adding a little bit more into inflation protection, looking for asset classes like liquid alternatives that are not really highly correlated with other more traditional asset classes. So just understanding that shock, understanding the consequences of that shock, pushed us to increase our allocations in that direction. Yeah, that's interesting. I think, one of the things we talked about in the paper was you don't want to overreact, but at the same time, you don't want to underreact, right? And we'll come back to stagflation. I mean, that's my least favorite type of inflation, but we'll talk about that in detail and how we protect against that. But another question I'm getting on the road a lot. This came up in BC this week, in the Prairies the week before, in Regina and Saskatoon the week before that. I mean, I got to get home at some point. Is what's the goal of all of this? So DW, what is the goal of this?
Right. So, I mean, I assume you're talking about the U.S. and the policy measures. Yeah, I mean,
all of this uncertainty, I mean, is it some sort of magical return of manufacturing jobs? Is it some sort of new world order? I mean, what is the goal of all of this that we've observed since the start of this year?
Right. So as everybody in the room knows and online knows, it's been chaos. And one wonders sometimes if chaos is the goal. And obviously that makes it very difficult to invest or forecast on that basis. I mean, if there's an organizing principle, particularly with respect to U.S. policy as it relates to financial markets and the global economy, I would say it's sort of a one of grievance in a sense that, the Trump and the administration seems to be of the view that the U.S. has been taken advantage of, as he put it, has been ripped off. Because it's been the consumer to the world, it's been the reserve currency and the financial asset, the liquid market to the world, it's provided defense, and it's kind of let everybody free ride in a sense. And, there is a kernel of truth to that. The U.S., I think, has benefited more than anyone from being the global leader, but there could be a better sharing of burden and costs and what have you. But how you address that is not what we've seen, right? Which is to say, so we'll take the trade side, so all the tariffs. So the Trump is of the view that a trade deficit means you're subsidizing another country. That is not what a trade deficit is. I'll give you a simpler example of why that's crazy. So let's say, you're individual, you got $100, you go to the grocery store. Right? You go buy some groceries. You have a trade deficit with the grocery store. Right. You're subsidizing the grocery store.
And by the way, $100 at the grocery store today gets you like one thing of lettuce and 2 strawberries. But,
that's about right.
Yeah.
And that's now. Imagine a year from now.
Yeah.
So, okay, we don't like subsidizing. So we're going to put a tariff on the grocery store. Yeah. So tariff is a tax. So you're going to go from making groceries somewhat unaffordable, as you just alluded to making it completely unaffordable. So you can't shop at the grocery store anymore. Right. So great, you're not subsidizing the grocery store. You're also, guess I'll starve.
Right.
Yeah. And the important point to note here is both sides are worse off.
Yeah.
Right. So the grocery store doesn't have the business, but you're home raising chickens and hoping you have something to eat. Right. So it really is sort of crazy and destructive. So there's a sense in which, Trump, to be very fair, has raised reasonable issues, but the answers that the administration is giving to address those issues is unhelpful, to say the least.
Right. Yeah, it's interesting to me. I mean, again, on the road, this comes up quite a bit, and I think about the share of U.S. workers that work in manufacturing. In 1940, it was 40%. Today, it is 7.5%, right? So more Americans work in restaurants, for example, than in manufacturing. And even if there's some sort of magical increase in the number of people that work in manufacturing, is it really going to move the needle from 7.5%? And as you mentioned, DW, the people that have benefited the most from this is, the U.S. consumer, because prices for those imported goods have moved progressively lower. DT, let me turn to you. Another thing that comes up is this Mar-a-Lago Accord. Take us through that. Is this the goal here? I mean, how do you think about this question?
Yeah, I think it stems from the same arguments that go into the trade deficit challenge, I would say, that the U.S. administration has identified, because there's a really powerful identity in economics where your trade deficit is equal to a capital account surplus. So I know that's, a little bit more technical than everybody's ready for this morning, but ostensibly the trade deficit that the U.S. has accumulated has funded a pretty significant capital surplus, which basically has funded the United States. And in the same spirit of the free rider challenge that the U.S. administration has identified, they would think that basically other international investors, other countries who are holding U.S. treasuries and other assets are getting a free ride. Because as we know, that is the reserve currency, that is the safest asset out there. So the policy response, again, trying to think about maybe a kernel of legitimate concern being masked by very poor implementation, is the notion of you want to basically charge a tax or an otherwise a fee to basically access the safety of a reserve asset. So, this is still very much in sort of the preliminary discussion stages, but I think part of it is embodied in what the Mar-a-Lago Accord really wants to do in terms of affecting the role that the US dollar plays, because as we know, the US dollar and a dollar-based financial system is really, really important, and it's really defined how capital markets operate. So any challenge to that, any push in that direction, arguably is something that is even more important for us as asset allocators and more important for the market to get its arms around, because that'll happen very quickly. And we can dig into a few of these little smaller countries' currencies, and one in particular, if you look at the Taiwanese dollar, has moved a lot as you're getting a sense that these global imbalances are starting to be challenged. And this is not a new story. I mean, I remember 20 years ago, you and I, Ilan, worked at the Bank of Canada trying to model a disorderly adjustment to global imbalances. So this is something that has been building. As we know, when something builds for a long time and when you do finally get a catalyst, I think the consequences are really, really important. So I think we need to be very mindful of that.
Right. And it's interesting you mentioned back at the Bank of Canada. I remember, this is 25 years ago, this idea that every time David Dodge mentioned the word global balance in a speech, right, you had to take one. Anyway, that was for a different time. Right, global balance was certainly the word of the day. But DW, how do you think about, will the U.S. remain the world's reserve currency? I mean, this is a question that came up a couple of years ago. We addressed it in a thought leadership paper. And to be honest, when I used to get that question, I don't want to say I was dismissive, but I was a little, maybe I was dismissive.
Things have changed.
Yep.
Right? A lot of things have changed, and the view on the U.S. dollar as a reserve currency has changed as well. So, first of all, just to level set, there is no such thing officially as a reserve currency. There was in the 50s and 60s and early 70s where you had other currencies pegged to the US dollar and then the US dollar pegged to gold. So there was official reserve currency. Now it's called the reserve currency because it's still used as such. And the reason it has remained the reserve currency is because it's useful. It's been useful as a means of transaction because everybody accepts it and people trade in it. It's been useful as a store of value, which is really because standing behind it is the largest economy in the world, the most deepest and most liquid financial markets in the world. DT, as you mentioned, the US Treasury is the reserve asset, and so the risk-free asset that people want to put money into when times are tough. And everything the U.S. is doing, whether it's the capital account side or the trade side, seems to be, frankly, intent on trashing the dollar, discouraging people from using it. And that's pretty scary, right? And it means that, it's not like tomorrow it all of a sudden is not going to be the reserve currency of the world. It may, be a year from now or 10 or 50 or what have you, but the administration, and to come full circle on your question on what is the point of this, I don't know if the point of what they're doing is to trash the US dollar, But if I was wanting to trash the US dollar, these are the kinds of things that I would do.
Right, exactly.
Right. So, and we need to take that into account in the management of the funds. So, as DT mentioned, we had, and I think folks in the audience know this, we've had a long-standing overweight to the US dollar versus the Canadian dollar in particular, in fairly significant way. We've eliminated that.
Yep.
Right, and we eliminated that, to DT's point, very quickly when it became clear that we were moving from a strong dollar environment to a weak dollar environment. It's one that we think is going to be with us for quite some time, and we're moving our allocations accordingly to the rest of the world.
Yeah, that's interesting. We're going to click into a little bit more of that. I want to sneak in a question here, a follow-up, DW. Is what we're observing right now a cyclical bump, and a year from now, we'll be back to normal, back to where we were 12 months ago, 18 months ago? Or is this a structural shift? How are you thinking about this? Is another one that's come up quite a bit in my client interactions.
I think this is structural.
Okay. I was afraid you'd say that.
Yeah. Well, I mean, afraid, I'd say that. So I think it's structural because even if you have a different administration, something happens, you've done, I think, durable damage to the U.S.'s place in the world and its reliability, whether it comes to trade, whether it comes to financial markets, et cetera. So one of the ways to think about this, and again, we're adjusting our allocations accordingly, is a lot of folks online in the audience, we've talked over the years, people would come up to me and say, why do you guys hold all this different stuff? Like, U.S. equity is the best market in the world. It's got the best companies in the world. Aren't you just diversifying yourself by not being just in the U.S.?
Right.
This is why you remain diversified all over the world. Yes, it's been a fantastic 10, 15, 20-year period for U.S. assets when the U.S. was ascendant. And I think we're going into a multi-year period where the U.S. is going to underperform the rest of the world. And we're addressing that with our allocations.
Okay. Yeah, that's a lot.
Can I just jump in?
Yeah,
one
absolutely.
Point? Because I think it's also important to be a student of history. And yes, we've been very much conditioned by the current period of the U.S. outperforming. But if you go further back in time, that hasn't always been the case. There have been periods where the U.S., dealing with some of these structural adjustments, have underperformed. So it's just an important observation, is it just to really appreciate the totality of history as opposed to just focusing on the most recent cycle.
Yeah, no, that's a really good point. I mean, again, it's much easier to forecast the past than the future. But okay, we have to turn to Canada. We have a little bit of time left, and I do want to turn to Canada. Where does Canada sit in this new world? Maybe we'll go to you, DW, or
we'll go to DT. Start on economy.
Oh yes, sorry. We'll go to DT.
Bank and
we'll go to DT. Where does Canada sit in all of this? The Bank of Canada reaction function, right? We talked about stagflation. How are you thinking about this?
Yeah, so I mean, this is the interesting thing that I sort of alluded to off of the top when it comes to Canada, because you typically think of an environment where the U.S. dollar is under pressure. That would mean that you would see a stronger Canadian dollar just by the sheer arithmetic of it. But you also need to appreciate that there are instances where the economic linkages between Canada and the United States are really important and can dominate that currency impact. So you could say a case that the Canadian dollar could certainly appreciate from here, but you also need to be mindful that if the U.S. economy is doing a lot of this self-inflicted harm and ends up in a recession at some point, that is a very significant shock, I think, to Canada's trade economy. And that's something that we need to be certainly mindful of. So we have certainly trimmed the degree to which we are underweight the Canadian dollar, and instead want to be underweight the Canadian dollar against a broader basket of currency. So you can really think about the currency evolution from our perspective as more to do with removing US dollar exposure as opposed to just really wanting the Canadian dollar against a broader basket. And I would also note that we've been so focused on tariffs and trade and the links between these two countries, it's important to appreciate that Canada also has some fundamental challenges that exist prior to this tariff shock and will continue to exist. And again, I would just remind everyone to keep focused on the challenges that the household sector is still facing. So as we're seeing the housing market work its way through, still 5-year mortgage rates are resetting at much higher rates, and that biggest part of the python, if you want to think of it that way, is sort of happening this year. We have a pretty dramatic change in policy restricting immigration, and that's an important undercurrent to Canada's longer-term productivity. Those productivity issues, again, still not to go through this too quickly, but they still remain important and a challenge. And I think we might see certainly changes in government as maybe a reason for some optimism, but I just need to still keep my eye on what is happening outside of the trade picture when it comes to Canada.
Yeah, no, really good point. Okay, we have to talk about our former boss, right? At the time, we knew him as Governor Carney. You have a personal relationship with him. You worked for him. He hired you to the Bank of Canada. I sometimes joke you sort of sat in the next stall over. But I mean, how do you think about? Well, I'll just leave that with you and let you answer any way you want, because sometimes when it comes up when I'm on the road, I say, oh, I think we're out of time, but we're not out of time. So over to you, DW.
Sure. First of all, with respect to the stall point, at the Bank of Canada, the governor has his own bathroom.
Okay.
So that didn't happen. Right. But yes, so I think as many folks know, Mark brought me into the bank as his advisor in 2009, and we served together for 4 years. As a summary statement, I'm happy to click into as people would like. As a summary statement, I'm glad that the country is seeing he is, as I've seen, kind of our best and brightest. And I'm glad that the country is seeing that, and I think we're benefiting from having him in the seat. And I know there's been a fair bit of skepticism, and we stay out of politics assiduously. And if you remember, we were with us in January. Instead of talking about Mark, I told his favorite central bank joke, which I don't think I should do that again.
Well, I think there's only one.
Yeah, there is only one. But I think there's been concern in a lot of quarters that even if you change the person at the top, that the kind of, frankly, economic and fiscal mismanagement that we've seen over the last decade was still going to be there, same party, same government, et cetera. I think it's actually going to be quite different. I think it's going to be different. So Mark Carney is a very different person from Justin Trudeau. The team around him is going to be different. So a couple of folks, as it happens, I've also worked with. It's a small community in Canada. Carlos Leitao, who was elected in Montreal, former chief economist of Laurentian Bank, was finance minister of Quebec for a number of years. I'm sure he will have a prominent role. Tim Hodgson, who used to run Goldman Sachs in Canada, was elected in Markham. I'm sure he'll have a role. These are really experienced, really good people that I think are going to be importantly shaping things. So it still may look similar to begin with, in the sense that we're still going to have deficits. There's no question about that. But it makes a difference what the deficits are. Right? So if you're just borrowing money to give money to people, that's not good. That harms your economy over time. If you're borrowing money to make the kind of investments that you need to make in infrastructure, research, schools, hospitals, affordable housing, et cetera, that helps your economy grow over time. And that can be a net positive. Absolutely. So I think we're going to see more of that and less of the just giving money to people. And it makes me, I'll step back and pull in some of what DT said. As everybody I think knows, we've been underweight Canada for a long time, right? And when I joined Fidelity in 2013, Canadian dollar was at parity, and I said it needs to go down, a lot. Was on record as saying eventually we're going to trade probably close to the 2002 low at 62 cents. I don't think that anymore. I think we may have seen the lows, and we've come up a little bit. And if the U.S. is intent on trashing its currency, it may come up a little further. And in that environment, on a relative basis, and I think even on an absolute basis, I think one can be, and certainly I am, more optimistic about the longer term outlook for Canada as I've been in memory.
There's a lot more for us to talk about. We have to wrap it there. We'll pop up the QR code for the Elbows Up thought leadership paper. This was written, well, it came out over a month ago, but a lot of what we discussed here on stage is embodied in that paper. Please read it, steal from it, use the charts. A lot of really good content. DW and DT, thanks for a great discussion, and we'll see everyone soon.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.